Okay, so a lot of slides today. And again, this is only the half of it. I will put a video into the VIP mentorship channels. It's going to be pretty in depth. I'm going to try to keep it inside of an hour to 2 hours. Obviously, it helps that I have the editing possibility with the video, is what it is. All right. So here comes a screen share. Yeah, the VIP mentorship will be more in depth because I want to flesh out the concepts a little bit more. For example, a simulation of the influence of the delta of the collar on August 2nd and August 5th. This order is so overhyped because everybody talks about the pin. Very few people understand the influence of the overall structure, but there's so much more to this order than just the end of quarter pin. If we even experience it, which we have a couple of periods in the past where we do have sequential pins. We do occasionally pop the collar, quote unquote, but the influence in between is also significant. And I think very relevant to the type of market behavior we saw around the turn of August. For many of you guys, a lot of this will be redundant, but you never know what people don't know. So I'm starting from scratch here. So the collar itself, just to get the fundamentals out of the way. I do think most people already know this, but again, you never know. The fund is the Hedged Equity Fund. It's the JP Morgan Hedged Equity Fund. It's a series of 3 funds. The collar fund is the largest of the 3, or the quarterly collar fund is the largest of the 3. The other 2 have sizes, again, which I'll flesh out more in the VIP mentorship. But the takeaway here is there's 3 funds. All of them are active all the time. They have positions that are open all the time. There's an overlapping. So while we look at this one because of the size of the trade and the concentration, there are about 15,000 more collars that are outstanding in different expirations adjacent to this one. So the key points, which again, some of the misconceptions or misinformation that circulates about this fund are very easily reconciled. If we have audio problems, I hope that it's just one off. So if anybody has an audio problem, the easiest thing to do is just disconnect and rejoin. But of course, if you have an audio problem, you can't hear me. So thank you guys in the chat. Okay, so the main points again are usually reconcilable if you just took the time to look at the actual fund's prospectus. A lot of the flows that we talk about, you can glean in like a wealth of information just by looking at their actual published documents, if you know where to go. This one can be pulled right off the JP Morgan website. The key points, it's designed to provide a consistent hedged experience. So underline, bold, underscore, consistent. It means that nothing is changing about the way they do this ever. So a lot of times, even now, there are accounts out there that are quote unquote authorities in the options space that talk about whether the contracts will roll or whether they're monetized or if they've already traded. This is very clear. It's opened and then it expires. That's all that happens with the old order. JP Morgan, the fund managers at the fund will never ever touch this position once it is properly defined at the end of the trading day. So I say that kind of with an asterisk because you guys might know about the restriking trade or the real, if there's a roll involved at all, it's really this one. At the end of the day today, because they will make the first trade around 2 p.m., if the market moves, the fund has to restrike the trade. That's the only quote unquote roll that actually happens in this entire structure. The other thing that happens is a reset. It's a total misconception to call it a roll. But besides that, the other point is there's staggered start dates. It's reset every 3 months. And at the beginning of the hedge period, an options overlay strategy is implemented based on where the market is at that point. So again, the important things are this is all systematic and it's well defined. The first part here, I already drilled. It's consistent means consistent. JP Morgan, they never ever monetize these puts. They don't cover the short call on the rallies. The fund never touches this. So you open it and then it expires. That's it. Every position is held until it expires and resets with the next one. The staggered start dates really just go to amplify the point that though this concentration for the quarterly is the largest and most significant in terms of pinning, which I'll talk about a little bit later, each fund contributes to the overall Vanna profile of the index to the extent that they're struck against a similar level. Used to be the case that they were struck against similar levels. We have more of a sideways drift in the market. But with some of the sharp rallies, we've gone through some of the collars, for example. Of course, the ones that are between 5 and 10,000 the adjacent months, it's much easier to pierce those collars. It's almost trivial in terms of concentration size. For example, a 5,000 lot collar at any given point, that option size or any size on a strike is no bigger than, for example, the Global X ETF fund. So, yeah, I don't know. The audio inconsistency, I have no control over, obviously. Back to the staggered start dates. What the fund actually does is they use SPXW end of month PM settled options. So the execution happens on the last day of the cycle. Now, obviously, it says here in the slides, I can just go back for a moment here, quote unquote, at the beginning of each hedge period. Now, we know that's not exactly the case, but technically you can make the argument that it is. Excuse me. Because the fund trades in a way where the hedge that is traded today is technically not covering any of their position until tomorrow, until the first day of the new quarter. And I'll explain a little bit more why that is when we talk about the 0-day provision, which again, that's probably the biggest confusing point for most people analyzing or talking about this collar. And to their credit, it's a pretty opaque domain and there's a lot of noise around this. But I think I'm correct on what I'll tell you after this. Again, it's not confusing. They're not looking for any type of call. They're just taking what they get. So the point of this structure is that they are guaranteeing that their client's portfolio, which is like the SPX, but not entirely the SPX, they're guaranteeing that this portfolio is hedged to the degree described in this profile here, right? So they buy an 80%, 95% put spread with a 3-month tenor. That means for the entirety of the quarter, their portfolio is protected for a move beyond 5%, but not beyond 20%. So at the 20% level, the losses that will accrue will start kicking in for the client as well. They'll begin losing 1-to-1 with the market itself. But of course, the put spread will pay them something significant along the way too. So that said, the other side of this is the funding of the structure. So the fund sells the out of the money call, but they are not choosing any call structure in particular or any call level in particular. They don't care. Of course they care, but in reality, they're just taking what the market gives them. And so what the market gives them will be, in their terms, whatever call makes the structure free to trade. Of course, it's not truly free because the trade-off is the upside, but free to trade is the important point here. They're not paying for this hedge. They are funding it with the call structure. This is a pretty classic overriding approach or hedging approach, I should say. Sometimes the middle two strikes or the top two strikes are really most frequently traded in the index, but some of the classic large block vanilla hedging programs do involve complete spread collar structures instead of just a risk reversal, which is what we would call it in the SPX if you're just trading the put versus the call. So if you look at this, some things that make the call strike higher or lower, the most basic one is the forward. So right now, for example, because rates are non-trivial and higher than dividends, the forward right now in December 31st is quite a bit higher than where we're trading in spot. It's a few dollars higher than, for example, the basis of ES versus SPX. What this means then is that even though we're striking the reference against spot, we're actually using and trading into the market that's determined by the at the money forward, not at the money. If that makes sense. All things equal, that means you're fixing the put strikes, but you get to sell higher premium calls. That in turn means that you can sell a farther out of the money call. And that's what we've seen happen as before. This used to be known as an 85, 95, 103% collar. That was because when forwards were much lower, that tended to be the call that they would get. Now it's been about 105. I think maybe in June it was as high as 106. I can't remember exactly, but it's roughly 5% out of the money, which is what we expect to see today. And to simplify all that, just remember this. It's always 80, 95 put spread versus whatever call makes it free to trade. You can literally just go into your brokerage platform, choose a basis. What I mean by choose a basis is pick an SPX level. This will be adjusted because they do need to match the SPX level of the quarterly expiration. So that means today, when they roll the trade, the reason they roll the trade at 4 p.m. is because they need to match their strikes approximately to the closest available strikes aligned with the closing settlement value for the index. It's not just any value intraday, it's the closing settlement value. Sorry, to circle back to the main point there, you can just structure this yourself. And in doing this, now, this profile here was actually created many days before Friday, even. It just happened to be that the SPX reference was 57.33, which turned out to be Friday's close. Now, obviously, that's partially due to the collar itself. But the point here, this payoff profile from Vol Studies, the idea here is when you're a market maker and you want to learn how to think of all these trades from the perspective of a hedger. Now, this, of course, is not a dynamic hedger necessarily because this static payoff profile is just understanding the options payoff structure. If you hedged it at the time of trade and held it through settlement, the market maker is obviously adjusting. And those adjustments are what we focus on in VolSignals most of the time. But the point here is pretty much the same. The payoff profile shows you, and again, what we're looking at is a hypothetical trade, which would happen today in the D's quarterly structure. It's going to be different probably because vols have changed. So as vols move, it's going to change the call strike. But when I created this, it was accurate. And fundamentally, it's still accurate for the point that it's trying to make. The point that it's trying to make is that when we talk about this collar structure, remember the JP Morgan fund is the customer here. They're not the dealer. That might be confusing for people because obviously JP Morgan as a big IB is known as a dealer. But when we talk about it in this context, they are just a customer. They're not even trading the order themselves. So they hand this off to another broker, generally UBS, who handles the order through the floor because all SPX volume like this has to go through the floor eventually. Now, what that means here, when we talk about this through our lens, the dealer side of the trade is what's shown here. They're short the put spread and they're long the call. And against this, they sell futures. And this kind of describes the actual amount of futures that hit the tape, quote unquote. In reality, it's not that easy because there's a lot of stuff that goes on here. And I'll talk about it in a second with the 0-day provision. But what happens here is largely defined by this. And you can see this is looking forward, but imagine right now that you just did the last one. We are right on the market maker's worst case outcome. For all of the talk about market makers screwing over customers, it's all just noise. Everything comes down to concentration and dynamic flow influence. And so what's happening now is, in effect, when there's a massive concentration in the market, it's difficult to avoid some kind of recursive behavior, right? And so when we trade as market makers, we are trying to offset every risk we have, but sometimes you just can't do that. And there's a lot of analogies here, and this kind of this runs the gamut from 0-day to actual risk parameters, right down to like long-dated Volga. The point is, you can't offset a massive concentration when end users don't have a natural offset. Eventually, hedgers have to hold the position and they have to hedge it. And so right here, what you're seeing is, of course, that massive concentration. And sometimes when you have positions this large, it compels others to follow into that trade or piggyback it, quote unquote, because any wise participant is going to know that they have an added edge, for example, because they're playing off of these market structure dynamics. If they can add to a concentrated position, theoretically that position will benefit them. Just to talk a little bit about the execution itself. This tends to be the greatest source of confusion. And I've never executed this fund flow myself, obviously. I was a market maker, so I faced it all the time. In facing it all the time, what I would say just anecdotally is throughout the course of my career, it mostly traded live on the trading floor. What that meant was like 2:50 p.m. Chicago time, Joe Butler at XFA or whoever it was at the time on the floor would get a call from UBS. The trade was already basically lined up. The bank already selected the strikes and knows what they're going to do. They get to keep 40% of it, but the other 60% market makers are entitled to make a market on and trade, and everybody does. With 10 minutes to go, because they're trying to match the end of day settlement as close as possible, they would quote this live and just rattle off the strikes. Everybody knew what it was or should know what it was, although I've seen market makers make mistakes there, which is hilarious, and just trade. At that time, it would just be a pile up, a ton of futures going to market. If you were to look at the intraday profile, for example, of ES volume and price many years ago, you'd see the influence pretty clearly. A complete erratic move between maybe 2:50 and 3 p.m. Central Time as all of this stuff traded, and every market maker was just pitching 500 lots or 1,000 lots into the order book. That's not the case anymore. What they do now, and I can't remember the exact time where this changed, but the point now is that they use a 0-day call. The 0-day call there's a lot of noise and, in my opinion, wrong takes about why the 0-day call exists and how it's managed. I've done a lot of not only thinking, obviously, but I try not to just speak out of turn. Obviously, I know my boundaries. I know what I didn't do and I know what I did do. I know what I do know with certainty and I know what I don't know with certainty. What I will say is that this domain is so opaque that I can't validate 100% that what I'm saying is completely certain in the way it's done, but I'm very confident. I've gone to great lengths to try to validate it with those who would know. And so, that said, here's what actually happens with a 0-day call. There's no delta impact at the time of trade. The reason is they provide this. And so when JP Morgan comes to the floor via UBS, they are quoting market makers on the put spread structure, which again, for example, today would be that 45-90, 54-half, 60-20 D's quarterly put spread collar. That would have a huge market impact at the time of trade if everybody had to hedge the 40 delta approximate when it happens. So instead, they add the 0-day call. But it's really, I don't know which rationale came first, but really, it seems like it's primarily a solution for the fund, not the market, which makes sense because the fund's first order of business is doing its execution correctly. And so the reason I say that, I want you guys to think through what's happening here. The fund has a mandate. It's not some guess. It's not loose in any sense of the word. Their mandate is to be hedged against 100% of notional. Now, we usually don't go too much into math, but just note here that 100% of notional is not the same thing as 200% of notional. And so in order to do that correctly, think about what happens today. The prior collar is not rolled, it's reset, it's carried till expiration. That means that this fund, if they were to trade at 2 p.m., there would be this 2-hour window where they were in violation of their mandate. Now, even if you could say that's a technicality and maybe there's a loophole legally or contractually where it's still above board and there's no legal risk, the fact is they have a massive P&L risk. They're going to have a huge slippage on what they're promising clients because of potential for moves in this period. Now, of course, it's not so clear why that is, but if you think about it, the fund is not concerned necessarily about delta per se in the way a market maker is. Instead, the fund is concerned about making sure that they are hedged in the way they define it to be. And the way they define it to be is hedged against 100% of notional. They are completely comfortable with the fact that when this is out of the money, it doesn't matter. The client's portfolio performance is driven entirely by the underlying equities themselves. That's defined, that's understood, and that's accepted, and that's expected. What would happen if they were to enter this collar at 2 p.m. and have this period? They would be exposed to the entire market movement influencing the collar that they just put on, which has, again, a massive delta. Now, the P&L attributable to this would be the same thing as if they synthetically sold, in our case with our payout profile today, 46% of their entire equity position at 2 p.m. Of course, that wouldn't make sense, and they would have a huge deviation against their intended marks every quarter. Even if they could do this, they wouldn't. And so the reason they throw the 0-day call in there is very clean. It solves this problem because now you have 4 components and 2 are synthetic and disappearing. You have the underlying equity portfolio and you have their new collar, you have the underlying equity portfolio and their existing collar, and these are locked. This is mandated. This is the hedge on 100% of notional, and we know also by their prospectus, etc., that this is held until expiration. There's no room for anything else. And so if they were to open the new collar, they'd be mismatched. The reason they open the collar with the 0-day call, first and foremost, is to protect them and their interests. The 0-day call acts as a synthetic underlying portfolio against which the new collar would be paired. And so now as the new collar moves around, market makers are hedged at the trade, but really more importantly, JP Morgan is hedged until the end of day on this new collar. Now, they don't want to be hedged because they're not trading it like market makers, but they need to be hedged. In this case, it needs to be covering something else, not the underlying equities. And so the inclusion of the 0-day call perfectly maps what they need with what they can do. Now at 4 o'clock, the two components that are option intensive expire, and the new collar perfectly maps with the underlying equities. There's nothing going on where, for example, JP Morgan is trading delta because of this. In theory, that would hit the market. They're just not. Their side should not have a delta influence because they are the natural counter. They're the natural counterparty for it. Some people claim that some people claim, and I thought this at one point too until I really thought more about it. Some people claim that someone or some entity is providing the hedge. And in doing so, they have to cover the hedge, meaning they're providing the 0-day call, and do that, they have to trade futures with it. And that's complete nonsense. I'm very confident in saying that's completely nonsense. Their provision of the call addresses their fundamental problem with the new collar. And when it disappears, that position is solved, it's gone, and at the perfect time, completely within their mandate, the new collar is entirely mapped to the underlying equities. And this allows them to do this whether by design or just by chance. This solution also absorbs the market impact. Now, I say absorbs because it just absorbs and redistributes it. In the past, it used to be pretty messy and chaotic because of the way that we'd have to trade futures live at the time of trade. Not the case anymore. But it's not a free ride either. So, yeah, they let the 0-day call expire to the question there. It needs to, because the 0-day call's only purpose is a temporary hedge against the new collar, which cannot be written at that point or purchased against their notional, their underlying equities. So they need to have a synthetic amount of delta to map it to, and that's a 0-day call. And the moment that they can attribute the new collar to their equities is, of course, the moment the old collar expires. Of course, that's the same expiration as a 0-day call, so it all works perfectly. But just going back to the market impact, excuse me, the takeaway is that the impact is absorbed and distributed. It's not lost or disappeared. The reality is the trade itself is going to have an overall market impact now that should map to the close. The reason that is because market makers, when we trade the 0-day call, we trade that entire structure hedged. It's delta neutral. So we're not necessarily doing anything at that point. However, we know that as that 0-day call expires, our portion of it, usually market maker will get 2.5 or 5% if we're lucky, but our portion of it will wind up disappearing from our position, leaving us exposed the entirety of the delta that it was previously providing us. And so to do that, for example, in this case, if we're selling a 0-day call, we need to then make sure that we have a way to replace this with futures at expiration. The way you do this is with the CME's BTIC contract. It's the basis traded index close. The point there is that is a market on close contract. You trade at a basis which is relatively stable. It does move a lot when there's big order flow like there will be today. But what you get at the end of the day then is a futures sale, not at market necessarily. You commit to the future sale when you enter the basis trade. The basis that you trade at just tells you at what price versus the SPX cash settlement do I get to buy or sell a mini. So if I sell this BTIC contract, I'm getting basically assigned a future sale at the close. If I sell it at a price of $54, the price that I'm going to get back from the CME when it routes to me is whatever the SPX settlement value is for the day plus 54. And so it's smoother because A, you have much more time to work out of this position. It's not just taking all these minis at once. And there's much more depth at the close. And so now it cleans up the process a little bit. There should still be a net impact, of course, but it's unclear and it's not necessarily predictable in the sense that it was previously, because you don't know if there's a natural counter to this. And now it's thrown into the entire mix of the expiring SPX position, because market makers use this not only to, actually, fairly speaking, market makers use this more as a tool to manage the overall delta, not so much a trade by trade level delta. The concentration here means that we're almost certainly trading it ahead of the collar or alongside it. But generally speaking, the impact or the overall influence is going to be netted out through the entirety of whatever we're going to be doing at the end of the quarter, which of course then faces everybody else's natural flow as well. So it's very noisy and it's not easy to predict why, for example, we would move a certain way. The collar is no longer as predictable as it used to be because it used to have a very local sensitivity where you could say for sure that this amount of minis were being sold and we'd have some kind of thrust down. Not the case anymore. So in theory, at the end of the day, if we are through the call strike, the entirety of the hedging flow means that, the entirety of the hedging flow, if we're through the call strike, means that we would have a delta buyback. And so that would mean that market makers would have to buy back whatever delta they were fully short against the expired in the money call. And you'd net that impact out against the delta they would be selling against the new collar. And in theory, if we're through the call or we pop the collar, for example, the influence net would be bullish. However, if we're in between the strikes, the influence net is unambiguously bearish, is what it is. Whenever you see people making claims about either or, that is the way it works. As far as the restriking, the mechanics of the restriking are just, again, because you trade at 2 p.m., but you might have a big move. For example, in August, we had a big move, similar to the one we had in end of May as well. I don't even want to speculate as to why that move happened. What I will say with certainty is that move in and of itself has nothing to do with the collar's mechanics. And that's even more cartoonishly emphasized by the extent of the move in August relative to the actual trade quantity of the smaller fund. And whatever move happens today, that's if we get a severe move in either direction, just know that's not because of anything happening with the collar. If anybody claims otherwise, they're just completely making shit up. I don't know. There's a lot of that all over the place. But strictly speaking, the mechanics of the collar are defined and well knowable. So the restriking, though, happens because of that big move. They need to make sure that at the end of the day, they are mapped against whatever the actual settlement is. They can't know that settlement at 2 p.m., of course. And the bigger the move, the bigger the restrike. If we don't move at all, there's no restrike at all. There's no need to. The P&L associated with the restrike, if they have to pay or receive, should be naturally offset with the P&L intraday with that 0-day call provision. But the point is, restrike just trues up the position. And so if we rally, they need to roll the strikes up. And if we sell off, they need to roll the strikes down, right? Because if we rally in the extreme, like 1 or 2%, now that put spread is no longer an 80-95 put spread. It's like a 78-93 put spread, which is not what they want to have. So they'll need to roll that up. And the influence at the close, of course, is actually non-traditional, or it's the opposite of the traditional spot vol influence. Typically, we assume that a rally brings vol for sale. Very technically here in this window at the quarterly settlement, the last few minutes, a big rally will see market makers get lifted on vol because buying the put spread and buying the call to roll them obviously is a long Vega trade for JP Morgan and a short Vega trade for market makers. Conversely, if we sell off and JP Morgan has to sell their old put spread and roll down the call, or UBS, whoever does it, that is a short Vega trade for the fund, but a long Vega trade for market makers. And of course, when market makers buy Vega, you tend to lower implied volatility. And conversely, if you sell Vega, you raise implied volatility. So here, the last 2 hours, if we get a big rally, vol could potentially spike in the close. And the opposite, if we get a big sell-off, vol could get hit pretty hard in the close. There have been a few closes in my career I can remember very clearly, where that's been a very good trade because of A, high vol levels to begin with, which is not always the case, and a large move, especially lower. This is an easier trade to take on lower when vol gets just crushed recursively. We'll see what that is today. But to move on to the more dynamic influences, I guess there's one question here. Wouldn't they use the 0-day leg to offset the first 2 hours of the new collar? Yeah, that's exactly what they're doing. The 0-day leg has nothing to do with the old collar at all. It just happens to be the same tenor. The tenor is because they need to make sure that they have a synthetic delta that will expire at the right time for their new collar. Right? Okay, cool. I try to be clear on that. I know it's weird, but it's also pretty clean and elegant too. Let's see. I'll talk about some of the questions later because otherwise I will never get through this. So about market influence, The point I want to make here is that the pin is not the only thing going on. Like, just look at this profile here. Take any other period, for example, because we know that all the smaller positions map to 3-month structures as well, right? But they're closer to 5,000 or 10,000. If you take any period and compare the price path in between the structure's existence, you probably would not notice such clear influence as you do when you look at the quarterly structures. And most people just think about what's happening now, or what happened last week. But really, what's fascinating is how much this evolves over the course of its life, especially, I think, relevant when it's about 4 to 8 weeks out. It becomes Vanna intensive in a way that correlates with the VIX. So, the point here I want to make again, I already covered a little bit about this, right? So, at the trade, market makers are going to be buying Vega because net, the whole structure is going to have short Vega for JP Morgan. And so market maker side, long Vega. It's because the put and the call that are around the money wash out. The call actually has more Vega than the put because of the forward. It's a nearer the money strike. And then of course market makers are buying the small like 5 delta put, which does have some Vega, not a lot. So net, this is like buying straddles. I think when I drew up that payout profile, the equivalent was about 6,000 or 6.5 thousand straddles that market makers would be buying on this trade. What that means is that there's a noisy kind of attempt to pregame this trade. It's very difficult. It used to be very clean. It used to be so clean that the trade would happen and literally you knew not to touch it because somebody would come in and call through EDF and lift you, and these strangles that were basically the strangles that you just bought in the trade. It was such an easy trade, and they would pay up in halves and dollars because it would get so suppressed into the trade. That stopped happening after COVID. Everything became a little more algorithmic after COVID and less game theoretical from like a negotiated perspective. Now it became so noisy that there was almost no edge or no discernible edge. The volatility around trying to capture the edge was just completely eroding the trade itself. So, impact at time of trade, I wouldn't recommend trying anything with this. It's a game that market makers and dealers are playing and much more sophisticated and really, in my opinion, just too random now to even make sense of because everybody is doing the same thing. Here's where it's interesting though. Okay, there should be an arrow here. Hopefully your slides have it. There's an arrow between skew and Vanna and an arrow from underlying and volatility. This is where it gets interesting. So in the beginning, there's really no gamma here. I think everybody knows that and understands it. When you take an option that's 0 days to expiration and you switch it into something that's 3 months out, just get rid of all the gamma in your mind. Nothing is there. It goes to a Vega intensive option. It's going to have some gamma, sure, but it's tiny. And with Vega, we care about Vanna, and it does have an influence. It's just not as clear and it's not as easily tracked and observed day to day. But a quick rundown, we know that the position that we care about is skew. It's the risk reversal. It's the short put and the long call. Short put right below the money and the long call above the money. We know that when you have skew, what you need to think about is Vanna. It's your Vega profile. How does it change with spot levels? And then, of course, how does your delta change with vol levels? There's two things here which make it recursive and make this kind of really a strange thing and really fundamentally behind some of the very fast moves that you get in the market and in vol because of that recursive nature. So a quick primer if you don't know already, a lot of you guys do know. With Vanna, it's two ways. When the market goes down, market makers get shorter Vega, and the response there is dynamic and it's automatic. Most people will be raising Vega on their slides, raising IVs on their slides, sorry. So you could short something, you raise it. It's pretty basic. If the market goes up, we get longer Vega, and we're going to lower implied vols. This is the whole nature of the vol crush idea. This is what people think all the time, and this is, of course, dependent on the positioning. If market makers are short all the upside calls and long all the downside puts, we would never talk about vol crush rallies. It would be vol crush sell-offs. This is fairly benign. But what about when vol moves first? When has vol moved first recently? I don't know. It seems maybe thematic. Okay. Still, same thing. We're talking about skew and Vanna. But now, from the opposite side, we're going from vol to the underlying influence. If vol goes down, market makers get shorter delta. If you go back to that payoff profile that I put in the slides, just eliminate the option delta here, and you have a hedge. The hedge never changes. It's D1, it's linear. There's no decay here. You have futures. If your option delta, which is changing all the time, shrinks, and that was long delta, now you're naked short some difference here that you need to cover, and you buy futures to do that. It's pretty basic. That also happens with time passing. Fundamentally, that's why we talk about supportive charm and Vanna flows. That's what that is. Now, if vol goes up, it's the opposite. And that gets bloody sometimes because when vol goes up, traditionally, you also see a couple of other things happen at the same time. Vol going up strips gamma from the option chain, right? Because it's like adding time to all the options, and suddenly they're no longer very gamma intensive. The distribution widens out. And even if you had the exact same option position, there's less gamma for market makers to hedge, assuming they're long to begin with, right? So, what does that mean from that point on? We know that market makers aren't just simply stacking orders in the ES book, but the fact is, when they're long gamma, they're providing liquidity in the underlying as well, whether implied or explicit. They are giving depth to the book when they're long gamma. So when vol goes up and it strips options gamma out of the chain, you're taking market depth out of the market from this source, right? So that's one element that's structural, not related to this particular trade, just overall. This particular position has an additional feature in it where, because of the Vanna sensitivity, assuming you're right in between the strikes, the vol going up forces market makers to sell futures. Now, of course, a couple of things are happening here. Vol going up removes book depth, but then forces you to sell futures. This is why concentration is so important for a market maker. As soon as we get a trade, the first thing we want to do is lay off the most like risk. So, first thought is Vega. Where do I need to sell Vega or buy Vega against what I just did? Of course, this is assuming that delta is already covered, right? The second thought is, okay, what about skew? Can I buy or sell skew somewhere to cover what I just did? The next thought is kurtosis. Do I need to buy or sell kurtosis to cover what I just did? And so on and so forth. And it gets pretty granular. There's a lot of proprietary ways to model this stuff and approach this stuff. But in the end, the point is you want to eliminate as much of the like risk as possible. Because if you can put up a bunch of similar payoff profiles and you dynamically hedge them all, as long as they're offset pretty closely, you're not going to have any big problems. But when you have a big concentration like this position is, the concentration produces a very clean and well-defined outcome in your need to hedge. And so it produces a lot of variance in your path. Of course, where I'm going with this is back to August 5th, right? To me, it's fascinating. If you look at the path in SPX, we have ping-ponged off of the strikes almost perfectly. Really, you couldn't get more perfect than this, right? Because there's so much noise in the market, so much other flow outside of this. For anybody to look at this path of the index and the vol path and know that this position is there and to say there's nothing to it, they're completely out of their mind. Strictly speaking, I don't have, for example, the intraday vol path on all these strikes. When I was at a market making firm, I would have access to a tremendous amount of granular detail. Meaning I could tell you, like, minute by minute, as my model responds and calibrates to exactly what the market's doing, like the bid ask of every asset, I could tell you really second by second what the delta was on every single option in existence in this domain. Can't do that when you're on the outside. You have to make some assumptions. I did as well as I could, speaking with some other colleagues at market making firms to validate the delta ranges of the options. The point is, going into August 2nd, we already had a little bit of a vol shock as VIX spiked, I think, like around 10 points late that afternoon. The index sold off a little bit, but going into Sunday's reopen, the three options in the structure had distinct characteristics heading into that moment. And primarily, Vanna was driving the bus, right? And so if you remember the pass through, the important thing here is if vol goes up, market makers get longer delta because the distribution suddenly widens out and everything becomes nearer the money. So now that call that they're long becomes a higher delta call, and that put that they're short becomes a higher delta put, and that put that's way out there, of course, becomes a higher delta put too, but it's not picking up a lot yet. This produces a waterfall in futures. Not sure I put the exact numbers here for you guys, but what's going on here is pretty basic. Now, this is an understatement. This is intentionally an understatement to not oversell the mechanics. I want to be like hyperbolic here. But if the structure's delta changed by 1%, 0.01 or 1 delta net, which Just to be clear, it changed by much more than that. The instantaneous hedge response necessary, not possible, but necessary for a market maker who needed to keep their book flat, if you were holding the whole position, was 800 futures instantaneously. Now, I don't think I put book depth in here, unfortunately. But just to drive that home, let's see. Dude, I'll have to put it in the chat later. But the market at the time was probably between 3 and 10 minis deep. So you can imagine everybody all of a sudden, a lot of this is automatic, right? And so all of a sudden, there's some amount of participants that are holding positions like this or this one specifically that have to sell futures, and it's happening instantaneously, irrespective of what's going on in the book. And so in doing that, some amount of minis is sold very quickly as vol spikes, but it's sold into a market that almost doesn't exist, which is why fundamentally you start to see these massive drops here, massive declines. Probably even more so as you approach some key periods where other firms are coming online. But people are waking up effectively and noticing, oh, shoot, I'm long a tremendous amount of futures on this new vol surface. That's real delta. It's not fake. It's not implied. It's if you move $1 from there, your P&L that you're marking in your position is different. You have to trade it. You can't just leave it. So you have to sell futures, despite the fact that you're putting yourself in pain's way or in harm's way. Now, what's fascinating again, which of course I'll talk more about in the video for the mentorship guys, this stopping point is not accidental. Now, again, I don't want to overstate the influence here, so I'm just going to strictly speak in terms of what would happen if this were the only position in the market. Of course, it's not. But just from this perspective, if the only position in the market, generally what would happen? You shock the vol surface higher, and you're selling a lot more than 800 minis at the time. It's much more than 800 net because of the amount of delta that's going into these options. That would probably produce a pretty hefty cascade in futures. And as that happens, your profile is changing because remember, these options are sensitive at different locations. And so when the options are around 20 delta, that's the max Vanna. That's the fastest that they're going to change when you're raising vol or dropping futures. Now, what that means, practically speaking, here is when they're about 20 delta and you raise vol, their deltas are going to change the fastest, meaning you're going to have the most minis to sell or the most rapid amount of, you'll sell futures at the most rapid pace is the way to put it, because the delta moves higher the fastest at that moment. But of course, it's all dynamic and it's happening across an array of firms that are trading at different times and mapping their position to different marks. It's not exactly continuous because it can't be. It's discrete, of course, when you get down to the actual flows. But when you get here and all of a sudden you're at the put strike, there's a reason we have changes in character at the put strike, because now that you're here, you're on the straddle. The straddle has no dynamic influence to care about. You're not having any real change in your Vega profile coming from that big middle option. It's stable because you're there. But your wings are not stable at all. In a strange way, they're actually helping you. So you get to the put strike, and all of a sudden, whatever you need to do has exhausted its course. Meaning, you keep raising vol from here, there's no more influence. You don't have delta to sell. It's already sold. Now you have two wings that offset each other. Way out of the money put and a way out of the money call. I guess not so far out of the money now on these vols. And they have competing Vannas, right? So like they're balanced. That strangle is going to have approximately the same delta if you raise vol more or take vol out of it. The flip side of this is the gamma on your Vega. And so this vol, or obviously this moment here is a vol spike. The vol spike happens, you're getting shorter and shorter Vega for some period of it. And eventually you run into your put strike here as you're changing spot levels and you're raising vol. You're actually getting longer Vega because suddenly this option way down below, which had no Vega before or a very small amount of Vega before, is picking up Vega where your straddle's neutral. You can keep raising vol, your straddle's going to have the same amount of Vega, but as you raise it, the call option way above and the put option way below have more and more Vega. This is vol of vol. This is like having a VIX call. And so as you do this, think of what I just said there. This is like having a VIX call. So VIX spiked, and we got to a level in the futures that gave market makers a synthetic VIX call. And what happened to vol after that? It got completely crushed. Again, I'm not saying that's the reason, because vol gets crushed all the time, right? But fundamentally, this would have exacerbated the move in the vol crushing. Because once you got to a certain point, everybody realized, oh, shoot, I'm getting longer and longer Vega, but it's way too high. I need to sell it. It's just like gamma hedging, but you're gamma hedging on your Vega, not your underlying. And so it all settles down here. Now, the rest of the price path on the way back up, I'm not going to walk through all of it here, but a lot of it is just the reverse of what we just talked about. Because Vanna and time work the same way. So once we bounce off of this, because of course when you start to stop, there are a couple things that happen, and these are all just assumptions. So now I'm no longer talking strictly about the position's requirement from the market maker's perspective, but just from the fact of, okay, there's a lot of people here that are hedged here. And so of course you might see buying because that's when you would step in and buy equities, when you know that any lower than this, you're protected. So you naturally get bounces. They used to be called put floors, I think. But it's a different kind of put floor because it really depends on the end user's reflex. So you get bounces a little bit, but these bounces then bring the market maker back into the Vanna profile. So as you're back into the Vanna profile, now the higher you go, the more vol you get. And so you need a lower implied vol. But coming from the other side, usually people like to sell vol and race each other to sell vol. It puts you into this recursive position the other way, and it keeps going higher and higher. You might get some aberrations, of course. We have had pretty much a prolonged period of realized volatility in excess of what we were used to, slowed down last week. But that fundamentally is the nature of the position's influence when it's a Vega intensive position. So now, just to fast forward a little bit, we get to last week and it's no longer a Vega intensive position, it's a gamma intensive position. And so gamma, as you guys know, a lot of you guys are in my group or have gone through my courses, etc. This is fundamentally what you can see every single day very clearly. Now, Vanna is a little bit harder to figure out because it requires you to understand what's happening to every single strike vol. Not easy to do or generalize, but gamma is pretty basic, and so is charm because time passes the same for every single option. And gamma is, for the most part, it's going to be noisy around vol changes, but it's pretty much stable. The opposite side here, as we got towards the strike, it produced a waterfall not in futures, but in realized vol. Because gamma allows everybody to start providing liquidity on the underlying, and it really consolidates the range. Here you go. This is last week. When everybody's talking about the seasonal weakness, the seasonal swoon, in addition to the post-SEP OPEX weakness and just the traditional post-OPEX weakness, here we are instead having the exact opposite happen. Not weakness, but at least perceived strength, and not volatility or an unclenching, but really a reclenching or a clenching. That's because of the way gamma and charm behave. And so again, this option has delta most of the way here, from left to right on the graph, and its delta is decaying. And so if there's any kind of gentle drift higher, it's because of that decay. Especially when an option has around 20 delta, its delta is going to decay the fastest. Just like charm again, these points in the distribution are most interesting around 20. The delta decay requires there to be a passive kind of bid, the underlying, which we've talked about many times via the options depth kind of profiles and putting numbers on it as well. But it doesn't need to be huge. The fact is it's there. It's like an invisible hand, a gentle hand, which of course is probably perceived by other participants. And there's that reflexivity that happens on another dimension because of people following into the reflexivity. Here we got to whatever day this was, Thursday. Market opens way above the strike in relative terms. Most people are assuming we're going to gap through, there's something to it, et cetera, et cetera. The fact is, not everybody hedges gamma overnight. A lot of people don't. Many people would just turn on their systems at the open for whatever reason, especially in the SPX. If you're managing an ES position, you wouldn't necessarily do that because you trade overnight and you're settling into futures and futures trade around the clock. But in the SPX, you're mapping everything to volatility. And traditionally speaking, most of that means close to close. And for whatever reason, there's a lot of people that would not even touch futures until overnight. Probably most of the bank type market making desks or prop shops that don't have capacity to scale into high frequency systems. There's the opposite of what you may see on Twitter kind of being posited or people guessing about the type of move you see in the open as being a gap higher, etc. No, the opposite is what you should expect. People are going to wake up and see themselves long a lot of futures. If you just make an assumption, because of course you don't know what every participant is doing, but on this move here, where you had the waterfall in the open, if you assume that just 1 out of every 5 participants or 1 out of every 5 contracts was hedged by someone not hedging gamma in the overnight, but only regular trading hours, that would have been something like 6 or 8,000 minis, somewhere in that range, to sell at market on the open. And why not just sell them? Because you just way over realized whatever move was baked in for your break even, right? A $40 move here for a market maker holding this position is an absolute gift. You're up a ton of money. And if you don't sell it out, you're just riding tremendous amount of long delta gapped through the highs, knowing that other participants have the same problem as you. So of course you sell it out quickly. It'll be interesting to see if we still come in. I don't have futures up live right now, but if we still come in well below the collar, just know you might see a little bit of the same, but the influence can fade. Now, as you guys can understand, there's a lot more even to talk about here. When I flesh out the examples with some delta mapping, the videos get long pretty quickly. But just to talk about today's kind of influence. And so the big problem here is that this becomes increasingly local. And you need to always bring it back to what flows are even possible out of the position, right? Give me 1 second here. Trying to pull up a live market here. You need to bring it back to what flows and the position still produce. So right now I see it, we're still trading around 57, 78 with a basis of 54. That's gonna be in the mid 20s. When we get to the options depth profile here on the chart, I will show you what that means numerically, but the takeaway is pretty clear. There is probably a delta buyback that's associated with the open, but there's no telling how much it's going to move the needle, right? Now, if you guys are in the morning meetings, you should already know what these numbers mean on the gamma profile. This is local. This is assuming that we're here in both time and strike level at 57.5. But this value of 9,500, strictly speaking, this means that if we were there at that moment and the market dropped $1, you'd expect market makers to have to buy 7,600 futures to hedge it. Opposite side of that, if we rallied $1, you'd have about 7,600 futures to sell to hedge it. This becomes incredibly sticky, but again, incredibly local. And so if this were offset, you would see the influence disappear, right? If enough hedging flows took us out of the collar's range, it's basically taking out the call's delta entirely, and there's no more influence. We're not there yet, I don't think, but that's the white range in between. If we don't come in and have a bid on the open to get us back into that kind of middle zone, and again, Doc put the delta of the call in the chat, that's awesome. 20 delta is peak charm. That's really what it is. It's going to produce passive buying flows that are the strongest. And sometimes in my career, I've noticed that we've had these strange pinning days where the delta never seems to change. It's misery for a market maker because if you remember, market maker, you're long that call and you're short delta. And if the delta never changes, that really is painful for you because you're not scalping anything. You're just decaying premium and riding short futures towards the strike. That might be what we have today. We'll see. We would need to get, in my opinion, if we get out of this influence here, really, again, the options depth profiles really help you see clearly where the influence is bound. This little table I put in on the right-hand side, this describes pretty clearly how strong the passive flows are. And so if you remember last week's meetings in the morning, I discounted them because, of course, like 2 to 5 minis every 5 minutes is nothing. Who cares, right? Not going to move any needle at all. But if you're talking about 30 minis a minute, now I've fast forwarded the influence here. I've condensed it to every minute because it's getting strong enough to care about. This gets interesting. This becomes pretty compelling as far as a pin goes. And this is exactly the type of stuff that keeps us stuck to the strike, right? Because if we're below the strike, let's say at 2 p.m., and you have to buy 83 minis a minute, well, okay, that's going to provide real support here. And if someone follows into the trade and forces the market higher, what kicks in, which is still very relevant, is gamma. And so ironically, you're like scalping your delta in kind of different dimensions where the thrust higher than you sell the minis you just bought. If you wind up at 57 double or 57.55, you have the same problem the other side. You're selling minis every minute. And all of this leads to the same outcome, which is you are converging the market on your strike, which is also your worst case outcome as a hedger. Now, in the life of this position, it's not like any market maker is looking at this stuff we're talking about today and saying, oh no, we really did it this time. We're out of business. No, there's a ton of stuff going on. They're hedging, in fact, if they're doing it, reduces the P&L variance around the position. This concentration at the end is painful, but it's not painful to the extent that it's knocking out their P&L over the course of the term at all. It's just a local kind of coin flip that you have to endure. And oftentimes you have a recursive position. And so your participation does make it worse for you. But you should have been able to make money along the path. This is almost comical, but of course, this giant bar is the JP Morgan strike. The position has been stable. The customer position may have seemed to grow a little bit because what's happened over the course of the block is that the bank, whoever's held the position, which I imagine is UBS, has steadily offloaded parts of it back to market makers. So now it's entirely held by market makers. They are the ultimate bag holders in the end, and they are probably the most likely to dynamically hedge it on a pretty high frequency. If we fall away from this influence, there's this zone here where there's clearly no options really bought or sold. There's maybe small local hedging right beneath it, but nothing material. This is again from Friday. I don't know if this has changed much. We can see on the options depth profile intraday. But effectively, there's no catch here until you get to, oh yeah, the middle zone is not negative gamma. I want to be very clear here. This whole area between the giant bar and these little clusters here, it's not negative gamma. It's not toxic. It's just, oh, shoot, like it's different. We've lost a major like guiding hand here. And so suddenly like a protective hand is gone and we don't really know what's going to happen next. Could be up or down, doesn't matter. It's more loose, it's more natural. But again, the point is not that we're going to go to toxic Brittany. We're not going crazy, dangerous necessarily, and erratic, realized vol. We are going to stability. It's just lower. We don't see this again, really, at least this amount of it, until we get much farther down the option chain or much lower in spot levels. Doesn't mean that this will happen. Just know that based on the character of the market, right? Based on the dealer's hedging flows, the character of the market is such that there's this wide range in between the type of market you had last week if spot moves. Or there's a wide range at which like it's completely different. There's really not a lot of hedging, maybe 1/5 the amount of gamma you've been used to, 1/5 to 1/10 really. Doesn't mean negative gamma, just means you can read it as dealers just aren't there. There's nothing really. So expect that tomorrow you'll see a bunch of stuff go around like Goldman Sachs talking about a record 1-day change in gamma again. It's just again because of this one specific call option. It's going to be a very different tone of the market tomorrow. So again, just what I've been talking about recently, I thought we'd wind up closing out the week mid 16 VIX. I thought it happened much sooner. I thought we'd get there and then stabilize. We didn't actually get there right away. We drifted lower, in fact, to the mid 15s and then climbed into the high 16s. So I was wrong there. And then we wound up today. It looks like we're going to open up in the low 17s. The point of that meme I put out the other day too is this is just one element of the picture and it's increasingly local. And so all it takes, for example, is some amount of flows to offset that entire position and it's gone. And that could very well happen with something like we saw with the Nikkei collapse like it did Friday. All this stuff is weighing on the index, but the index is propped up by this one position and the gamma hedging around this one position. Now, some people talk about this as having a Vega influence. It doesn't really. There's really no Vega to talk about in a 1-day option that matters for what we care about, right? I would never think about Vega inside of 30-day options. It doesn't make a lot of sense. They become increasingly gamma sensitive, spot sensitive, and decay rapidly. In my head, Vega is 2 years out, 1 year out, 6 months out. But in retail space, I have to adjust. It's closer. And most people talk about the VIX. So 1 month Vega, fine. We call it Vega. But the fact is, this option has nothing to do with that anymore. It has nothing to do with Vega, everything to do with gamma. And dynamics today don't change, for example, what someone is going to do or not do about a position they need a month out from now. And running up into the election period, VIX is going to climb no matter what, because we know there's a jump that's baked in. So usually there's a roll down. Now it's going to roll up because of the fact that the S&P options that the VIX are priced on or priced off of are after the election, right? And so the VIX cash index is not some loosely defined thing or loosely traded thing. The cash index is just a calculation. And it's a calculation based on the 30-day out options in the SPX. That calculation is clear, it's defined, you can get it off the CBOE's website very easily. Point is that because we know there's a vol jump, there's term premium for the election, that's baked in. And so if anybody's surprised about the VIX moving higher into next week, that's just silly. It's already there in the option chain for you to see. Don't know what's going to happen exactly, but what's Interesting to me, and this was taken from Thursday's meeting. I don't think the positioning changed materially since then, as far as the point I'm wanting to make here, is that in October, if you guys hear the term supportive charm and Vanna flows, if you hear it this time, just know that person doesn't know what they're talking about. You can completely write them off forever because the opposite is the case. And so if you look here, the reason that's the case is because of the Vanna and the charm we talked about before. For charm and Vanna to be supportive, market makers have to be long upside calls and short downside puts. That's not the case where we are right now. It might be the case if we drop considerably lower, but right now, the fact is we have this red bar here that you can see in the second third of the page on the right is October serial expiration. It's the client positioning or the customer positioning. The point is that usually this is, or sorry, this is the market maker's positioning. To be very clear, this is the market maker side. The point is usually the higher you go, the greener it is. That should be the traditional profile because clients sell calls to fund puts for hedges. So market maker's profile would be increasingly green above spot, and that produces the spot vol correlation that we're used to. If market goes higher, realized vol goes down, implied vol goes down, very clean. If market goes lower, the opposite happens. Right now, if market goes higher, it's actually going to become increasingly unstable because you're probably going to see a lot of hedging. You're probably going to see spot vol correlation spike. There's also a tremendous amount of VIX calls. This slide I didn't swap out, but Charlie points out too that the VIX dealer positioning, despite the fact that VVIX is a bit elevated, the cost of the price of vol is still a little bit high. VIX dealer positioning is getting a bit short again in calls. And so that's like market makers again getting short a lot of tails, a lot of puts especially. Whenever you think of vol or VIX calls, you can think 10 delta put in the SPX 1 month out. Or I guess depends on what term the VIX calls are. But the point is that's the type of position that is similar, right? Because a VIX call has a payoff that gets increasingly positive as VIX goes higher. As VIX goes higher, that's just saying the implied vols are going higher. It's the same kind of payoff that you would have on a Vega position if that position was getting bigger, the more implied vol moved higher. It's confusing a little bit, but it's the point is that as you have a 10 delta put, for example, if you spike volatility, it's going to become a more Vega intensive option. Whereas in the beginning, it has about, I think, 20 or 30% of the Vega sensitivity of the at the money. If you spike vol sufficiently to where it's a 20 delta, now all of a sudden it has closer to 60 or 70% of the Vega of the at the money option. And so owning that is like a call on implied vol. Anyways, I hope this was at least informative. It's about half of what I wanted to cover, but there's a tremendous amount here. Hopefully this clears up the most important things that I think are always misstated. Really, the zero delta call or 0 day call. Sorry, I always think of D after a number as delta. But the 0 day call, I think, is one of the most clearly misstated and misunderstood features. Also, the way they strike it, I don't know why this is not obvious, plain as day, because it's right in the prospectus. But there's a lot to it. And what I want you guys to remember is the Vanna influence. Now, I drill this all the time because it's so serious. It's not some joke that I know I make memes a lot instead of doing math, but people don't care about math, and either do I really. The point is, this is serious pass through. The market is not as liquid as people think it is. There's not as much depth as people think it is, or there's not as much depth as people believe there to be. You only get to see it when you need it, which is tough. And by the time you need it, the news comes in with 50 million different explanations for why it's gone. The fact is, all of this high frequency market making that has made their way from equities into options changes the entire liquidity and depth profile of the market itself. And now the fact that we have VIX call options that can make their way into SPX underlying levels is completely ridiculous. And if you think about it, the VIX itself was based primarily or constructed primarily to give you a barometer of market sentiment that was based on the S&P options chain in accordance with the calculation that I just talked about. The fact where we are now, you can't even begin to articulate it that way anymore, right? Because now you not only have the SPX options chain, which is the end user who should be hedging a portfolio that way, but you have the VIX, which is tradable not only via futures, but now options. So someone can bet on a future level of implied volatility, but the fact that the market maker has to hedge this means they have to then go back and buy VIX futures, which then means they have to go back and buy the actual strip of S&P options. And so it flows through two ways. But because of that added convexity in the VIX options, which is fundamentally unnecessary in many ways, it creates a massively whippy type of chain reaction where all of a sudden the amount of leverage implied over the end result is huge and never supposed to be there to begin with. It was just supposed to be a barometer of market fear, et cetera, whatever, but completely different than what people assume it to be. Now it's definitely dangerous and the liquidity disappears fast because everybody's playing the same game. As a market maker, you pull quotes immediately because you don't want to get picked off. It's not a noble profession where you're trying to be a martyr for the market. You're trying to make money and survive until tomorrow. And so if vol spikes and you have a position like this, your first response is to pull your quotes or gap your quotes. Make sure that you're in bounds legally with whatever you need to do for the exchange, but you're not providing any favors to anybody. You're trying not to lose first. And if you can win, that's great. But it is what it is. Hopefully it makes sense. And if there's any lingering questions, feel free to ask. I should have the video out to the VIP mentorship guys probably midday. It's a lot of the same content, obviously, but a little bit of explainer, a little bit of walkthrough, at least with respect to the deltas of the options on their path, and a little bit more time spent on the construction and the execution of this structure as well. So thank you guys, and appreciate you for showing up.
Worth it, let me work it. I put my thing down, flip it and reverse it. It's your permitted, but when yet, it's your permitted, but when yet, if you got a big, let me search it to find out how hard I gotta work. Yeah, it's your permitted, but when yet, it's your permitted, but when yet.